Good day, everybody. Welcome to this webinar. We're just going to give it a few minutes. I see people are still joining. So if you can bear with us, please, just 1 or 2 minutes at most, then we'll begin shortly. Okay, I see people are joining, but I think in the interest of time, we're just going to proceed, and they can join when they can join us as we proceed. Welcome once again to this webinar, which we're going to be talking about employment equity reporting. Very excited to be hosting this webinar today. My name is Fortunate. I'm a senior consultant here at Transcend, very much focused on employment equity, compliance and implementation within the context of transformation. So thank you so much once again. I hope that this will be a very good webinar for us today. Just to sort of like do a quick intro and mostly thank you to all our delegates that have joined us today. Most of you are quite regulars that join us on most of our webinars, but maybe just for the benefit of those that are joining us for the very first time, a quick intro in terms of our organization. Transcend is a company that's been in operation since 2005. Since then, we've been acting as trusted BE advisors to a large database of, multinationals, South African corporates, small to medium enterprises, and the company is made up of 3 divisions with specific focus to improve transformation, help clients in terms of implementation of BBBE. We've got Transcend Corporate Advisors, which focus on helping clients in terms of putting together BE strategies, consulting, implementation. Transcend Capital is a boutique corporate finance house, really focusing around the ownership element of the scorecard. The team there is very much well versed with regards to the requirements and help clients all the time with regards to the ownership element. We've got Transcend Talent Management, which is also a boutique recruitment firm focusing on the placement of Black executives, particularly into C-suite positions, non-exec directors, trustees, and things like that. Also very much focusing on the agenda of transformation within the workplace. We very much pride ourselves in terms of our values of improving transformation, and our values actually enable us to deliver when it comes to helping our clients in terms of showing up, being the trusted advisor, seeing the person learning and growing and driving real transformation, which is also at the core of what we do. As part of that, we also do quite a lot of work in terms of being in the forefront of industry news, new amendments of legislation, insights with regards to the transformation space. So if you would go to our website, you will notice a lot of work that we do around providing some insights, being first of mind as well when it comes to a lot of work around BE advisory and the projects that we've done. Part of what we've been doing in the past 2 years is to run a series of webinars just to enable our clients to be part of conversations of topical issues. We've run quite a series of webinars over the last 2 years. The last webinar I actually ran, it looked at Employment Equity Amendment Bill. We are currently anticipating some stricter changes to employment equity, and it's been very interesting to track that and to see as well what are some of the business implications that we can anticipate from the changes coming to employment equity. So that's all on our website to view past webinars. And I think just also to mention, quite interestingly, we've also been running a transformation survey. This is the 2nd year now. And next week, we'll actually be holding a transformation survey webinar in which we will be talking about what are some of the key trends currently in terms of BE. We look specifically about BE in the time of COVID, post-COVID, and how that is actually going to be implemented going forward. What are some of the issues, the challenges, the insights that are that came through that survey, which we circulated widely across industries, small to medium enterprises, as well as listed entities. So that's going to be very interesting. Also, an interesting panel just driving that to speak about what are some of the things happening within transformation and BE. Again, on our website, we also release quite a lot of information, blogs, and thought leadership pieces for anyone that wants to be informed about transformation. A lot of that information is available to our clients, to anyone basically, quite easily and free of charge on our website. So do head on to our website if you're interested to learn about some particular subject or some of the work that we've been doing and releasing as well. Moving on, in terms of our agenda for today, we are here to speak about the employment equity reporting season, which we are currently in. I will be taking you through that process, some of the key things that are very important to note as you start to prepare for employment equity reporting. I would assume that most people are here because to get some guidance on how to do it properly and to make sure that you meet the requirements. What I will be touching on today quickly as a background is just to look at the purpose of Employment Equity Act. Who does it apply to? We'll speak to the statutory responsibilities of employers. what are some of the key considerations when preparing your employment equity report. I'll take you briefly some important sections or parts of the EE report in the form of the EA2 and the EA4, just to sort of start getting an idea there as to some of the things to keep in mind. We'll also touch through the non-compliance risks. I think that's very important that we know, what are the risks of us not doing this properly, not submitting on time, and all of those things. We'll then leave some time for a Q&A. I do have my colleague on the line as well. Priya will be manning the chat box. So if you have any burning question as we go through the content today, please just drop it in the chat, and we'll also then just be sure to sort of tackle your questions as much as possible during the time that we have today. After that Q&A, we will then close the session. So that's our agenda for today. When we talk of employment equity, it's always important to, sort of lay the background. I think there are a lot of misconceptions. There are a lot of, ways of thinking when it comes to employment equity. Is it relevant? Is it not relevant? Particularly as well, we talk about, is employment equity about, true transformation, or is it about ticking boxes to say, have we done this? Have we done this? So, but I think it's important to always lay the context in terms of employment equity and why it's required. The history of South Africa itself, goes without saying. We stem from a legacy of, past discriminatory laws and, the apartheid era, which was characterized by things like job segregation, unequal access to education, unequal access to economic participation, which is part of the reasons why, post-94, we saw the enactment of these various pieces of legislation as a means to redress and to start seeing transformation and change, equal representation as well within the bounds of the economy, the workplace, and overall participation. So if we look at where we are now as a country, and we hear a lot about how South Africa is one of the most unequal countries in the world, and currently we've seen how during COVID we've seen high levels of unemployment and poverty, and all of that continue to massify the degree to which there are areas of inequality, as well as why it then becomes very important for us to consider employment equity as an important vehicle, specifically in the workplace, to say, how do we then start to improve representation and equal representation, which really brings us to why we have the Employment Equity Act in the first place. So the purpose of the Employment Equity Act, as laid out in the Act, is to achieve equity in the workplace by promoting equal opportunity and fair treatment in employment through the elimination of unfair discrimination, implementing affirmative action measures to redress the disadvantages experienced by designated groups, to enable equitable representation in all occupational categories and levels in the workforce. Now, I've deliberately bolded some of these words because, or not only because of their importance, but I think it's also one of those, those words that, or phenomena that we hear all the time, but most probably use them quite loosely. What is equal opportunity? What is fair treatment? And especially when we start talking of discrimination, and fair discrimination in particular, each and every one of us at some point, you may have felt in your professional or personal life, you may have felt that you've been discriminated against. And affirmative action as well. We hear about affirmative action not only in the context of South Africa, but as a global phenomenon where we are looking to ensure that there is equality, there is redress, particularly to persons that would have been previously disadvantaged. To sum up the purpose of employment equity and why we do all of what we're doing in line with the provisions of employment equity really is to say, how do we start increasing representation within the workplace? And when we talk of representation, in my experience, what I've often seen is that companies or organizations think of, representation as, for example, focusing on particular groups or demographics in the sense that, we do know that there are designated groups, previously disadvantaged person or underrepresented groups. But the focus of employment equity really looks at equitable representation, and its intention is in line with the Constitution, which looks at everyone's right, to fair treatment with regards to their participation. So it's not only about particular groups. We have to look at it holistically, identify areas of underrepresentation within our organizations, and any strategies would be put in place to sort of meet those needs or those targets when it comes to representation across occupational categories and levels in the workforce. And then the residual that the result that we are trying to find from there as well is to also decrease inequality within the workplace, and that has a ripple effect in terms of socio-economic development as well, and from the notion of nation building as well. So that's a critical part in terms of the purpose of the Employment Equity Act, and why it's there is really for us to start seeing transformation in our organizations in terms of representation, in terms of making sure that everyone is fairly treated and not discriminated against on any arbitrary ground, which can be their race, their gender, sexual orientation, religion, and etc. So it's very important for us to understand the why first, why we have the Employment Equity Act, so that we can also, when it comes to execution, the how, we are quite clear in our minds as to why we're actually doing this. So when we then look at the application of the Employment Equity Act and who it applies to, Chapter 2 talks about the prohibition of unfair discrimination, and that applies to all employers and employees. Chapter 3 of the Act is what we call affirmative action. And here, this particular chapter refers to what we call, applies to what we would call designated employers. So the definition or the criteria at the moment of a designated employer is to say it's an employer that employs 50 or more people. So if your headcount is 50 and above, you are regarded as a designated employer. If you employ fewer than 50 employees, there is the criteria to look at what is your revenue, what's your total turnover. And at the moment, we do have guidelines in terms of Schedule 4 of the Act, in terms of what is the applicable turnover thresholds that would apply to you if you were a company that is under 50. So this is what currently the Schedule 4 looks like, and as you can see, it's gives the sectors and the applicable turnover if you were in that particular sector. So from agriculture, if you are in the agricultural sector, is your turnover 6 million or above, then you are regarded as a designated employer. So you would have, if you're under 50, you would have to go and check Schedule 4 to determine whether or not you are a designated employer. I will touch shortly what it means to be a designated employer, or if you are a designated employer, what then are your statutory responsibilities that you have to meet. Municipalities and organs of state are also regarded as designated employers. Employers can be declared a designated employer in terms of a collective agreement. And lastly, at the moment, Section 14 allows companies that don't meet the above criteria, so under 50 or don't meet the turnover thresholds, to voluntarily comply with Chapter 3 of the Act. So for those that would have been following or that are following the movements with regards to the Employment Equity Amendment Bill, we do know that we are anticipating the repeal of Schedule 4, such that companies or employers with less than 50 employees will no longer be regarded as a designated employer. So they will be exonerated from some of those duties or complying with Chapter 3 of the Act. Also, we are anticipating the repeal of Section 14, which says that you can voluntarily comply. So that's also gonna when the Employment Equity Amendment Bill gets passed into law, you can no longer voluntarily comply. You would have to meet the requirements, which mainly looks at companies that have 50 or more employees within their organization. So if you are a designated employer, what is it that you are required to do? So statutory responsibilities of a designated employer. In terms of Section 16 and 17, you are required to have an employment equity consultative forum and to engage in meaningful consultation with the committee on matters related to employment equity. So this is a very important aspect of compliance, to make sure that you have a committee and that that committee is active, that you can prove that in the form of the minutes and the agenda of the meetings that that committee is actually having. So as a designated employer, it's important to make sure that you check and do that you have an EE committee in place and that it is actually active to comply with the Section 16 read with 17 of the Act. Section 19 says, as a designated employer, you should conduct an internal audit on employment equity barriers. What are some of the things that act as barriers towards improving representation, for example, in your organization? So typical barriers would be recruitment. Typical barriers will also look at, reasonable accommodation for persons living with disability. As an example, you need to be aware as an organization, what are the barriers that exist in your environment, and what are the affirmative action measures that you're going to put in place to eliminate those barriers. And so in order to comply with this part, you need to make sure that you've completed your EEA 12 to comply with Section 19. So that's also very important. As a designated employer, you should develop an EE plan, which is a minimum of 1 year and up to 5 years in duration. Your EE plan is your strategic roadmap in terms of how you're going to eliminate barriers, how you're going to improve representation within your workforce in terms of how you hire, promote, terminate, all of those things. So the employment equity plan is a very important in terms of complying with Section 20. And then in terms of Section 24, it says that as a designated employer, you must formally assign responsibility to a senior manager who must take responsibility for the entire process in the form of an employment equity manager. So it's also important to make sure that you've made your Section 24 appointment, and that person is there as an internal custodian who is monitoring the implementation of employment equity compliance within the business. Typically, this is not an HR role. This has to be an independent role, somebody that is senior to sort of like make sure and coordinate and bring to account when it comes to employment equity compliance. Then in terms of Section 21, it talks about every designated employer must submit an EE report annually to the Department of Labor, and that EE report should be signed off by the CEO. And for today, that's actually the focus for today, to look at the submission of employment equity reports and what are some of the key considerations when it comes to that. While we're on this part in terms of your responsibility, it's then very important for you to make sure that all of these aspects are in order, because, for example, in the event of a Department of Labor inspection, they would, for example, want to see that you have a committee, that you've got your EA 12, that you've got your EA 13, which is your plan, your Section 24 appointment. Have you been submitting your reports to the Department of Labor? So that's also very important. And I think also many organizations have been, Department of Labor has ramped up their efforts to enforce compliance, and we are seeing a whole lot more inspections than before. And these are some of the key things that they're always looking at to make sure, are you compliant or not? Obviously, there are a number of other things that you would have to comply with. So, for example, the duty to inform, the duty to make sure that the employment summary of the Employment Equity Act is displayed within your within your offices for everybody to see. Those are some responsibilities, but I think in terms of key responsibilities, the ones highlighted on the slide here would be things that needs to get paid attention to. So when it comes to employment equity reporting, very important, like I said, according to Section 21, if you're a designated employer, you are obliged to make sure that you submit your EA2 and EA4 detailing the progress that you have made within the reporting period, typically a 12-month period, in terms of achieving employment equity. You are required to submit without fail. There is no provision in terms of Employment Equity Act for an exemption, a condemnation, or an appeal in terms of failure to submit. You would, the Department of Labor is warranted to, impose a fine, a minimum of 1.5 million rand, if you fail to submit. And this was part of what we saw even during, COVID last year, the hard lockdown. The Commissioner for Employment Equity, the Department of Labor, still kept that stance to say that all employers should still report, should still make sure that they uphold the provisions of employment equity. So you are required to make sure that you submit. If for any reason you're not able to submit, there are justifiable grounds, such as, transfer of business, Section 189. So if you went through a retrenchment, if you are going through business rescue, or liquidation, those are justifiable grounds. Or if you are a designated employer based on your turnover, and your turnover has plummeted below the threshold such that you're no longer a designated employer, you would need to inform the Department of Labor. As I speak today, this should have happened by the last working day of August. So that's always the cutoff to inform the Department of Labor that we will not be able to report this year because of 1, 2, 3. If it is your turnover, then you are required to also submit your latest audited financial statements to show that indeed you are no longer a designated employer. Simply sitting back and not reporting, in as much as you would have a proper reason, but if you fail to inform the Director General by completing the EA14 and submitting supporting documents, you actually would be regarded as having failed to submit, and the permissible fines of Schedule 1 would be applicable to that company if you have failed to report. So, like I said, who must submit is all registered companies that meet the criteria for the designated employer definition that I spoke of earlier. When to submit, we are currently in the EE reporting season window, and we are fast approaching the deadline. So the manual submission is allowed in the month of September. So from 1 September to the 30th of September, those that prefer to do manual submissions would have had the chance to do that. From the 1st of October to the 15th of January, we have the opportunity to submit via the Employment Equity online portal in order to submit your report. So in essence, from the time the system opens to when it closes, we've got 3.5 months to make sure that the report has gone in. Mostly, we do know, though, that many companies close over December, and so typically you would want to, that cuts out as well the amount of time that you have to make sure that you have closed the report. So yeah, I think now we are approaching end of November. That means that at most we are, even if we count the holiday period, we are approaching just under 6 weeks before the EE submission deadline for reporting comes through. So that's very important when it comes to employment equity reporting. Having said that, so in preparation of, in preparation for the reporting, what are some of the key considerations as an employer, as a designated employer, that you need to put in place to think about and to make decisions on? So the first thing, this specifically talks to companies that are, part of a group, that are part of your holding. It's if the company is part of a group of companies, an employer should consider whether to submit a consolidated report or to report per entity. So that's a decision that you can make. You can either do a consolidated report to the Department of Labor, or you can submit per entity. That specifically applies to companies that are part of a group. Then this is also important. The reporting method that you used, or the reporting cycle, should be consistent with the duration of your current employment equity plan. Because in essence, when you're reporting to the Department of Labor, it's a progress report over the last, or the 12-month period. So because we are tracking progress against your plan, it then needs to be consistent that if your plan runs from a Jan to December sort of cycle, it means as well that your report should also cover the same duration in terms of Jan to December, October to September, whichever cycle that you currently use as part of your plan. plan, make sure that that is aligned. For those that would have gone through a DOL audit and you were then required to revise your plan such that now your plan is now of a new period, which is not consistent to the previous year, you would then have to match what your current plan is. So typically you find that if you have a Jan to December plan, but then you get audited by the Department of Labor in July or August, they request you to rework your plan. It means that your plan will change in terms of its duration to accommodate from the time you received recommendations from the Department of Labor. So again, it will mean that you are moving to a new reporting cycle. So that's also very important to make sure that you do that. Ensure that consultation has taken place with all relevant stakeholders before the report is signed off by the CEO. Also part of section 16 and 17, or consultation with the committee, consultation with the unions. If you have a unionized environment, if you have shop stewards, you need to make sure that consultation has happened before the employment equity report is signed off and submitted to the Department of Labor. You should also have minutes that will prove that consultation actually happened when it comes to the report. So that's why it's also important to make sure that consultation has taken place. For HR managers, the teams that are in charge of putting together the report, please just make sure that consultation has happened. You must not just capture and submit, because you need to meet those requirements. And then when it comes to the alignment of your remuneration policy with equal pay for work of equal value, this is important, especially for your EA4, where you're going to report on salaries. You need to make sure that there are no unjustifiable differentials, especially for people that are doing the same work. We do know of the gender wage gap. In South Africa specifically, we also see an extent to which salaries are also racialized. So it's also very important that any income differentials are based on measurables when it comes to the work, but people doing equal work should not be paid differently without justification. So projections and tracking of your EE goals and targets as per the EE plan is very, very important. So it's important to make sure that you've made sure you are, tracking your EE goals, because that also forms part of the EA2 that you're going to submit. So be quite clear as to what's the headcount forecasting, what's the targets for the, in terms of the plan, what's the goal of the plan in order to meet that. And then again, you should always use the prescribed reporting forms. And to some degree, this applies to people that would go the manual route of submission. If you're doing the online submission, obviously the system is set up appropriately in terms of required information, required sections to be able to fully complete the report in the manner that is required by the Department of Labor. So those are the key things that you would need to make sure that you focus on as you prepare for the employment equity reporting. So just to look at, the employment equity report, what goes into it. First part of the report is the EA2. And the EA2, you report on your workforce profile, the current workforce profile, any movements that has happened with regards to your workforce profile, specifically looking at new hires, promotions, terminations. You have to make sure that you have all of that information to be able to input it into the EA2. One of the key things, and also, a common mistake that people make, is when it comes to the differentiation between people that are regarded as permanent and people that are employees that are regarded as temporary. So you would see that on the EA2, for example, in all the tables, it talks about total permanent and temporary employees. So typically, people view that persons that are on a contract, a 1-year contract, 6-month contract, 2-year contract, as long as it's a fixed term contract, they generally regard those people as temporary. But that is not the case. As per the definition in the Employment Equity Act, temporary employees only means people that have a contract that is 3 months or less. So somebody that only works for you for 3 months or less. Any contracts above 3 months, you would make sure that you capture those employees above the line, because as per the definition, they are actually regarded as permanent. So you need to make sure that you are aware of that, so that you don't skew your data between those that are permanent and temporary. Only if you have contingent workers, people working for you for less than 3 months, those are the only people that would be captured in this bottom line that talks about temporary employees. So make sure that you pay attention to that. While we're on that, in terms of the regulation and how information is reported to the Department of Labor, specifically when it comes to reporting job grading, it is important to make sure that you are aligned correctly to the semantic scale that the Department of Labor uses. So you would find that in all the prescribed forms of the Department of Labor, and typically as well when we speak it from a BBBE's perspective, the management control, we use the semantic scale in terms of allocation of hierarchies within the organization. So it talks about top management, senior management, mid-management, junior management, people that are semi-skilled and unskilled. Depending on the job grading that you use, and I've typically put in the most common, although in South Africa, we mostly see the usage of Patterson more than some of these that are labeled here. So you would need to make sure that if you are using the Patterson classic or modern, modern bend, that you've made sure that it's aligning correctly, because you wouldn't want to say that somebody is mid-management, whereas they are junior or they're semi-skilled. So how do you start? That's actually the first point of call. Is our job grading accurate? And have we properly aligned the job grading to whatever internal system you use? Have we properly aligned it to the semantic scale as required for the purposes of EE reporting, for the purposes of your management control on a scorecard, on the BBBE scorecard? Is very, very important as well. We often find that many mistakes are made here, where it's just plotted, it's thumb-sucked, and it causes a whole lot of problems if you have, plotted people incorrectly or positions incorrectly in terms of what their grading is and what their also resultant pay scale is, because you will then start to see the differentials, and those are the things that can cause problems, skew your data as well, or look as if, there are income differentials, whereas it's probably because your job grading is not accurate, is not done properly, and aligned to the semantic scale. So that's very important. It's seemingly a complex process. And sometimes you just need to make sure and double check and triple check that before you submit, your occupational levels are actually correct and aligned with how you've graded the jobs internally. So I think that's very important for us to note there. When it comes to the numerical goals and targets, there's often a confusion actually in terms of what is what. And I just wanted to just take the opportunity to sort of like highlight the difference. So when we talk about numerical targets, it refers to the workforce profile that you project to achieve by the end of the next reporting period. So let's say you've got a 3-year plan that started in January of 2020, and at the moment you're going to report, you are in the 2nd year of your plan. When it asks you about your numerical targets, in this example, it's saying, what is your organization going to look like by the next time you should report? So in the next 12 months. So this is where headcount forecasting comes into play, to make sure that you're quite clear as to what are the vacancies, who's in line for promotion, what does our succession planning look like, and to be quite clear as to the workforce movement that's going to happen within the next 12 months as part of meeting the objectives of your plan. The numerical goal is the end goal of your plan. So what do you project to achieve by the end of your plan? So this would make sure that you are tracking towards that. So each year we track our targets to which will take us to our goal. So numerical goal is the workforce profile that the employer projects to achieve at the end of the current employment equity plan. So let's say, like in the example that I gave, if your plan ends December 2023, that means that your numerical goal is how you have projected to say that you will look like by then. So in putting together the numerical goals, you would need to be quite clear in terms of what the workforce profile, and obviously the baseline is always what the current workforce looks like. And then you would have to embed into that some of the anticipated movement, whether it's a promotion of somebody from mid into senior. You need to account for that both in your numerical targets and in your numerical goals. Typically, you should be, in terms of your workforce profile, should be progressive. So not only do we anticipate your headcount to continuously grow from year to year, as an indication also of the growth of the company, but we also want to see the progression in terms of areas of underrepresentation and overrepresentation, and what you're doing to sort of close that gap. So if you find that, for example, that you've got a huge percentage of African females within the company, that means that for any new roles that are, that have to be hired for, or any new vacancies, it means that you have to target another demographic that is underrepresented. So, for example, colored females or Indian male, whichever according to the EAP is currently underrepresented in your company, including white males, white females. You would need to make sure that there is equitable representation. So it is of no use, and you would sort of also actually be penalized. It is of no use, for example, to place a huge focus towards hiring African persons, whereas other groups as well remain underrepresented. You need to make sure that you align it to the EAP, which is the statistics towards economically active persons, which tells us, for example, at a national level, that just over 43% of the population in South Africa is African males. That means that in order for you to sort of move towards a state of equitable representation, close to 43% should be African males within your organization. When you look at, for example, white males and white females, total population hovers between 9 to 12%, and you should then make sure that there is a balance, correct balance, when it comes to representation within your organization, and that you are focusing on targeted recruitment towards those demographics that are actually underrepresented across the occupational level. So if somebody resigns, what is the strategy to improve representation? Do we replace with a colored male? Do we replace with a white female? As an example, to progressively improve representation within your organization. So that's the key requirement there. And what I've been seeing recently, especially, like I said, I've been seeing that the Department of Labor is inspecting organizations more and more. And sometimes, yes, you have a plan, right? If the DOL says, hand us over your plan, you do have a document to hand over. But most of it, when they go into the detail, they will question the numerical goals and targets to say that they are not progressive enough. It doesn't show that the organization is committing to close gaps of underrepresentation. So you find that an organization would have a 5-year plan, but from 2020 up to 2025, their top management is going to still look the same. Their senior management is going to still look the same, which is part of what we've seen in the data, whereby we see overrepresentation, for example, of white and Indian population at top and senior management positions, where, you know, almost 66%, over 66% are held by the, you know, by white males in terms of that, which is, when we look at the EAP, that is a gross imbalance, you know, when it comes to representation. So how do we as an organization start to focus on those areas? So in your plan, you should reasonably say, you know, account either for natural attrition, or if you know that somebody is going on retirement, etc., or if you know that there's going to be transfer of work, etc. At any given opportunity, you must then improve representation of other demographics within the organization. So a lot of companies do come under fire when it comes to that. You have to rework your plan. You have to rework your goals and your targets to make sure that you show the progress, and not just, you know, it's not just numbers, whereby if you're going to still look the same, then the purpose of the plan is, you know, is void. Then the intention of employing equity is actually also not being met in terms of increasing representation. So that is very important. I cannot stress enough how this particular section, in as much as it may seem, you know, quite simple, it's very important to make sure that, you know, your numerical goals and your numerical targets are done properly. I think also to a large extent, especially we saw from last year when COVID started happening, how much conservative we now need to be. I know that there were a lot of companies that had projected massive growth, but, you know, within that sort of 12 months period, we saw, you know, a huge amount of loss, and business, it was not business as usual, and most organizations had to rework their plan, had to restructure their organization. So keeping track of your goals and targets to make sure that, you know, you're still in line. If they need to be reviewed because of any major changes that happen to your organization, it's something that you are advised to do, and to relook at your plan all the time where required. Then, so that when it comes, that's the EA2. The EA4 is the second part of the report, and here we specifically report on salaries. So there are usually a lot of confusion here on the EA4, a bit complicated as well in terms of particular parts and what is required, should be included, what should be excluded. Section C talks, you have to put together your total remuneration. So you put together the salaries of all the people within the organization, per demographic and per occupational level. What I must state, where another common error that happens is your workforce profile on EA2. If I can go back just one here. This should be as at a certain date, right? So if your plan or if your report is from 1 October to 30 September, it means that when you're reporting, you have to report employees as at a certain date and not just people that were there during the course of the year. So you would say, for example, what is my head count as at 30 September? As at 30 September, what's my head count? So that means that people that left the company during the year and etc. will not be part of this table, but will go under the termination section. What that means is that when you're now capturing salaries, it should only be employees that are currently in the organization as at the date of your workforce profile. So usually you find that people would have included everyone, including people that left, and typically people that left, they would have stopped payroll as well. So, you know, you can easily skew your data there. Make sure that your workforce profile is, when we look at workforce profile or the management control, it's always as at an exact date, not over a period. So it has to be at a particular date, like 30 September, 31 December, what's my current workforce? So on here, you would capture all the salaries, the total. So total cost to company, total earnings that each people, all people would have been paid. So obviously paying attention that you allocate it to the right bucket. Section D is where it becomes a bit complicated or quite complicated, because here you have to differentiate between fixed, guaranteed, and variable remuneration. So typically what here we find the confusion, especially around the variable portion of salaries, what is included, what's excluded. So you find that typical things in variable remuneration would be performance bonuses, commissions, incentive, any kind of monetary incentives that gets paid to employees is variable remuneration. Things like back pay, goes into variable remuneration. Leave pay goes into variable remuneration. Then when it comes to variable, there are fixed salaries. There are certain variables that people often confuse to say, is it fixed or is it variable? So things like your travel allowances, your telephone allowances, etc. So here, that's why it becomes very important that you're quite clear in terms of the remuneration structure of the organization and that you capture accordingly when it comes to here. Another important thing here is that you have to make sure that you've highlight the instruction as well, is to make sure that you only capture the highest paid person. So on this section, it's total REM for everybody. On section D, you have to look at the highest paid person at each occupational level across race and gender, all the way the lowest level in your organization, whether it's unskilled persons or semi-skilled or junior management, whatever lowest level exists in your organization, there you have to capture the lowest paid person. And this is in line with identifying the vertical remuneration gap. So again, that's where it can become complicated if you capture this wrong and, skew the data or just misrepresent the data. It becomes a problem. So make sure that you're quite clear what payroll looks like or what the remuneration structure looks like in order for this particular section to be captured correctly. One of the key things why it's important as well, when I spoke about equal pay for work of equal value, this is where as well it will become clear if you are paying people differently, especially on the same occupational levels across race and gender. Sometimes it's very clear to see when you're capturing this session, you will see how people are paid differently, especially on race and gender. so it becomes that's why it becomes important to say, have we aligned our remuneration policy properly to equal pay for work of equal value? And do we have according to our policy, the justifiable grounds in which we pay people differently? And that's actually, there is a section on the EA4 where you have to indicate, the reason for income differentials. So again, here, you must only choose a key reason. There may be a number that apply in your context. So you'd say probably we pay people differently based on their performance, but also on their seniority. But according to the instruction here, you only have to choose one. So a key reason in which you pay people differently. You would need to make sure that you've done these calculations correctly. What is the average annual remuneration of the top 10% of your top earners? You do the same thing for your bottom earners, as well as figure out what is the average salary that people earn within the company and be able to report on that. So that's pretty much in terms of the EA2 and the EA4. Like I said, you have to pay careful attention to the data and make sure that you don't miss anything or misrepresent anything, because then that would be an area of risk in terms of non-compliance. So having said that, what are some of the risks in terms of non-compliance? Number one, like I said, if you fail to submit for whatever reason, especially if you did not, if you did not inform the Department of Labor before August, the large financial penalties and fines will be imposed on your organization. Schedule 1 says that the minimum a company can be fined for failure to report is 1.5 million or 2% of your turnover, whichever is greater. For some of the bigger organizations, 2% of your turnover is definitely higher than 1.5 million. So you can easily be fined multi-millions for just failure to report. Then lack of recognition points on BBBEE for employment equity and management control elements of the scorecard. This is also very important. And because when your organization goes for a BBBEE verification, you are required to provide acknowledgement or proof, the acknowledgement letter from the Department of Labor to show that you have reported in that particular year or measured year. So that's why also it's important. If you fail to report, if you miss the deadline, or it becomes, sometimes if you try to do it the last minute, the system is actually hanging or crashes, and then you fail to report, you're still regarded as have not reported despite the reason that you have. And the implication specifically on BBBEE scorecard is that you will lose the 19 points for management control on the generic, and I think it's about 23 points for ICT. There are different points there per the sector, the different sector codes, but the minimum would be the 19 points on the generic scorecard. So very, very important. You cannot afford to sort of like lose that, especially just for failure to report. If you don't report, you will be excluded from the EE Public Register. It's published every year by the Department of Labor, and government and other companies are encouraged to do business with those that are on the register. We are also seeing with the amendment that with the incoming of the promulgation of the EE compliance certificate, is then to say you can't do business with the state if you are non-compliant from an EE perspective. And obviously, because of that, it also has implications on things such as your BBBE scorecard, because of that linkage between the codes, the BEE codes and Employment Equity Act. So that's another risk as well when it comes to that. Non-compliance is a statutory offense for which the company director, the CEO, can be criminally prosecuted. Usually we see criminal prosecution happening when it comes to misrepresentation of information, or we see executives being prosecuted for being charged with intent to mislead the DOL. So let's say for sure that there are income differentials in terms of your salary, and let's say you cook the books and misrepresent what your payroll is or what you're actually paying people. That is fraud, as an example. And so the person that is liable is the company director. So that is why it's also important that if you are an HR manager or in charge of capturing the report submitting, it must have the signature of the CEO, because ultimately it's going to be the CEO that will answer for it. And they sort of cannot delegate that responsibility to say, well, it was not me that captured it, as an example. That's why you cannot submit it without the signature of the CEO. So it's a criminal offense. It's a statutory offense in which can lead to criminal prosecution of the company CEO. If you are non-compliant, that becomes public knowledge all the time, especially now with the digital age, really makes a big risk when it comes to your brand value or your market reputational damage that's going to happen for failure to, for if you're non-compliant, if you're fined by the Department of Labor, if you are found guilty of unfair discrimination, things like that, that has a big impact in terms of your reputation. And I think specifically now, in 4IR, that's very important because everything is digitally driven. One thing, before you know it, the organization is trending on platforms, and people are actually dropping products or services of that company because of whatever has been associated with it negatively, as an example. So that's also a key reason to protect the value proposition of the organization, both in terms of your services and your products, but also in terms of your employee value proposition. People want to be associated with companies that are in good standing, that embrace diversity and inclusion, etc. So if you are for any reason found non-compliant, it's public knowledge, and it has an impact on those particular aspects on how you attract clients and employees within the company. Non-compliance invites further inspection and audits. Typically, you would be put through what is called a DG review. And so, that is something that you want to avoid at all costs, being on a DG review where the Department of Labor inspectors are coming in, they're checking everything, assessing the organization, assessing employees, all of that. And that is an absolute process that can be quite tedious, really, not only from a time perspective, but will start also, you see the implication from a financial perspective. So those are the key reasons, also some of the risks to avoid when we start, not only when it comes to reporting, but just making sure in general that your state of employment equity in your organization is actually compliant. But I think while we're talking about compliance and non-compliance, this is where it starts becoming an issue of ticking the box, because we want to be compliant, we want to avoid fines. At the end of the day, what's going to properly drive employment equity success is actually, like I said in the beginning, embracing the relevance of employment equity, embracing the benefits of, cultivating transformation, diversity, and inclusion within the organization. So that is the real vehicle that is going to actually contribute to EE success. These are just, I would say, the technical aspects of it, but we absolutely need to have a corporate culture mindset shift in terms of looking at employment equity, why we do it, and what are the benefits that we could reap out of it, except obviously when it comes to the fact that you won't get fines and things like that. So very important as well, yeah, in that regard. Having said that, I will just look at it to see if we have questions. I think I've covered, quite a lot, when it comes to the actual requirements. You would agree that, this is typically what needs to go into the report. So I think I have covered quite substantially a lot of what needs to happen. But we do have a few, we still have some time. So I'm happy to take I'm happy to see what are some of the questions that have come through. So, okay. Is the employer required to report or include on the workforce profile for labor broker staff? So yes, because it is, as per the legislation, any employees from a labor broker or TES automatically becomes your employee, especially when they have those contracts above 3 months. So you would need to include them as part of your reporting, because technically they are regarded as your employees or that of their employer and not of the TES or the labor broker. Can you have numerical targets and numerical goals be the same, assuming that the reporting period and plan end at the same time? So yes, that's correct. Because if you have a 1-year plan, for example, it means that you are projecting for the next 12 months. So your goals and your targets will be the same because you've got a 1-year plan. But anything longer than a 1-year plan, it means that your targets, which what you will be tracking year on year, your goals is what will happen by the end of the plan. But as long as your EE plan is only a 1-year plan, or you do your plan on a year-on-year basis, then yes, your numerical targets and numerical goals will be the same. I don't know if that answers the question specifically in the angle that you're asking it, but typically, if it was a 3-year plan, your targets should obviously take you to your goals at the end of the plan. We anticipate to have seen progression in terms of what your workforce profile look like. So that's why for a longer plan, your goals and your targets cannot be the same. You have to incrementally show the progress that you're going to make in the form of targets to feed into the end goal of the plan. I see a question here, and I think it's a very important question. It says, how much of the information in the EE plan is required to share with all employees? So while we're on that, you're actually required to make sure that the employment equity plan is readily available for all employees to see. So either on your intranet, in websites. When it comes to, if I walk into the HR office, it should be something that's readily available to see. So when it comes to the duty to inform, each designated employer must make sure that the EE plan is actually readily accessible to all employees. The only sort of place where it's a bit gray when it comes to salaries is the EA4, and you know, whether or not that should be fully disclosed or not. There is that double bind of, you know, obviously protecting salaries as confidential and personal information. On the other hand, when you're trying to promote transparency, equal pay for work of equal value. So the only thing that we've often seen is that when it comes to the EA4, that is mostly disclosed to the committee, if not the wider committee. Then at the very least, the Section 24 manager should have visibility to payroll and be able as well to request or to sort of like understand why there are differences in salaries, etc. So I think that's the only place where it can become, you know, a bit gray. But other than that, if you're asking specifically about the EE plan, the EE plan should be shared fully with all employees in the company and should be widely available. If the DOL audits you, they will say, show us proof that the EE plan is readily accessible. Where is it accessible for people? Then you can say, here it is, it's lodged on our website. Here it is, it's lodged in our MS Teams channels. Anyone can have access to it if they want to read it. You know, type of thing. The only thing that I feel where it's a bit when it comes to the disclosure of the EA4, but other than that, you should reasonably, you are reasonably expected to sort of disclose all the information in the EE plan to all employees. What are the implications on an organization with no plan of closing demographic gaps? So that's, you know, that is in contravention of the Act, because you, in line with Section 20 and Section 21, you have to make reasonable progress in closing demographic gaps to comply with the legislation, or else you're actually found non-compliant. So the first step is that the Department of Labor would give you time to remediate and to say, you need to give us a plan on how you're going to close all of those gaps. If you still don't meet that standard, then you will be referred to the labor court for failure to do that. So that's why it's very important that there is intention to close the demographic gaps as required by the Employment Equity Act. Just one last question. People are asking if the recording will be shared. Typically, we do put up the recording on our website and on our YouTube channel just a few days after the webinar. So you would be welcome to go over to our website or our YouTube channel, and you can rewatch this specific webinar or any other webinars that we've done in the past, as long as you are a delegate. So yeah, I don't see any open questions for now. So I think, thank you so much for those that put together their questions. We'll also just monitor any other questions that would have come through via other platforms, and we'll tackle that offline. So I think in closing, what we can help you as Transcend from an employment equity perspective is employment equity committee training. So putting together your committee and, you know, doing capacitation workshops to make sure that they understand the legislation, their role and responsibility in meeting the provision of Section 16 and 17. So we absolutely, you know, help with that. And then coordinating consultation processes on matters related to employment equity, at the very minimum, you are required to make sure your committee is meeting every quarter. So Department of Labor would request 4 sets of meetings at a minimum for that particular period. So if you would want somebody to run those, EE committee meetings every quarter, coordinate the consultation, speak to what needs to be, what needs to be paid attention to, etc. We are also available to sort of take up that role of helping in terms of coordinating the EE committee activities specifically. We can help as part of, Section 19 and Section 20, which talks about an internal audit as well as employment equity plan. If you need to redo your plan, review your plan, or you didn't have a plan before, we are absolutely able to work through that with you and put together a valid employment equity plan that meets the provisions, that meets and as well as best practice or the codes of good practice when it comes to the putting together of an employment equity plan. Also, just due diligence. Maybe you are doing your own submissions, you are putting together your own plan, but you're not quite sure and you want sort of a second check to make sure, so that you avoid any risks within your information, etc. We are also available to sort of do a due diligence exercise of verifying your information, and we'll say, yeah, I think you are good to go, you can proceed and submit. So just like a due diligence exercise of your employment equity file, we can do that as well. And then most importantly, as the subject of today, when it comes to submission of employment equity reports to the Department of Labor, as Transcend, we help quite a number of companies, large, small, in terms of doing the submission on their behalf, so that particularly for 2 reasons: to make sure that it's done correctly, and then perhaps internally we know that it's year end and everybody's quite busy. If you just don't have the time and the capacity to do it yourself, we are absolutely available to take that off your hands and submit the employment equity reports, capture it, submit it on your behalf as part of that. So that's the scope of our services from an employment equity services perspective. So if you are struggling on any aspect of, the statutory responsibilities, on any aspect of these provisions, then you are quite welcome to reach out to us, and we can see how we can be of assistance. So thank you so much. This is the end of my presentation today. I would want to thank everybody that took the opportunity, that took the time to be with us this morning. I hope that you also found it to be quite useful and that you're geared up for the employment equity report. If you're feeling a little bit nervous or not sure if you can do it at all, like I said, absolutely here to assist you. So I've now put up my details on the screen. You're welcome to reach out to me directly if you have questions, if you need assistance on any aspect of employment equity, do reach out to me. But once again, thank you so much, and have a great weekend. This is the end of the webinar.